this morning. The question was that will Indian markets follow? And yes, that definitely has been the case. Is this institutions offloading HDFC Bank at this point? That's the question. Down about 8% nearly as we speak. Let's look at the advanced decline ratios and talk about what kind of weakness we're seeing in the market. It's directionally very clearly been a day of a complete pressure coming in. But here, as you come towards the close, you're seeing the sell side increasing in its magnitude. Let's pull up the heat map, and no surprises for guessing what's going to be topping the list over there in terms of losers. Yes, HDFC Bank, Kotak Mahindra Bank as well doing badly. You have Tata Steel, Hindalco. But just look at it overall. If you take HDFC Bank out of the picture, which is down about 8%, you are seeing no massive deep sells on your Nifty majors. Yes, between 1 and 2% down on your big counters, but clearly this has been where the most panic is coming. Even ICICI Bank about 2.5% down, State Bank of India, IndusInd, all of them feeling the pressure. SBI Life is the only one up in the green this morning. HCL Tech also not doing badly as well. In fact, tech stocks have been a sort of a counterbalance. The only green spot that you will see in the market today possibly is from the tech space. On the broader indices, just let's look at how the mid-cap and small-cap indices are doing. And yes, there's been a lot of pressure coming there, but relatively not as bad as your headliners. What are the specific stories that you're seeing in the market today? And Hersh is joining us with more details on that, Hersh.
Absolutely, Tamanna. So, I'll try and stick to the positives in an otherwise overall, gash that we've seen with regard to the Nifty. And I'll start off with IREDA. That stock is up roughly a couple of percent MOU with IOB, and that's what's keeping that stock afloat. Of course, that stock has been doing quite well this week, through the week as well. When you're looking at some of the others, PNC Infra on the back of an LOA for a project that they've won, that one is up around 1.5%. Capri Global is up a solid 6%. They were on NDTV Profit earlier today, spoke to us, but of course now giving up some of those gains. Mass Financial also up on the back of a bonus issue which is expected to come through subsequent to a board meeting, 1.5% higher. And PTC has won a contract with Dassault, and that stock is higher as well in trade today, 2.7%. Quickly on to some earnings, some stocks with earnings impact. You have the likes of a Lombard, which is up. Again, auto making a comeback with regard to Lombard's numbers evidently, and therefore you can see that spike up on the stock. Jindal saw solid set again, margins really spiking up from the 9% to the 19% mark. That stock is up and away in trade. You have the likes of a Steel Strip and a Gallant Ispat, which are lower on the back again of numbers. So some of those stocks in focus on the back of everything that's happening in markets, Tamanna.
I would also mark out an L&T Tech for mention today. Numbers there getting rewarded, and IRFC continuing to do fairly well. Oracle Fin, Polycab also staying up in the green despite everything today, and that's one counter that we've been talking about. Two key brokerage upgrades have definitely helped it. But if I look at an overview, yes, of course, you have a sea of red today. But what is doing particularly badly? I would say your financials, your banks, your financials are getting hit the most. So are your metals. Look at SAIL, down about 5.5%, 6% today, when that stock was doing fairly well yesterday. Your Nippon Life, Vodafone, Godrej Industries, some of the key losers today in trade. We have Jay Bala with us. He's the founder and CMT at Cash the Chaos. Jay, definitely a day of chaos. No doubt about it. No other way to describe it. Let's talk about the indices first. 21,607 on the Nifty. Not sure whether 21,600 is also going to be breached. Where are you seeing the supports coming in at this point?
Thanks for having me on the show, Tamanna. The most significant move today is definitely the banking index, and we have been warning about it for the last couple of interactions. And I've been pointing out to completely avoid the banks as they were looking quite toppish even a few weeks ago. And the supports for the banking index is now quite wide open and it's quite deep. Its next support comes in about 44,400. But the Nifty is still about critical support of 21,448. And I guess Reliance is the only one that's holding it up, and Reliance looks like it's got an unfinished move to the upside, even though it's down today. It's probably got a last sequence of higher highs to come through. Once that is done, I think the Nifty would also start dropping. Or it could be that the further constituents of the banking index starts to drop, and index managers just try to manage the index by just keeping Reliance up. But the point there is once 21,448 breaks for the Nifty index, I think the downside is also due. But people who have listened to the NDTV Profit, to my views, they could have cashed in on chaos. We on the 27th of December, we had called a short on Polycap before the 28-29% drop, and we've been warning that we should be avoiding the banking index completely, so there's no chaos out there.
Absolutely, those views coming out very clearly. But let me also welcome on board Devarsh Vakil, who is the Deputy Head of Retail Research, HDFC Securities. Devarsh, talk to us how you're viewing markets, how you're viewing valuations, and more specifically, what does this result mean for HDFC Bank? What are the 2-3 key negatives and possible positives, if any, that you've been able to take out of this result?
Yeah, hi. Thank you for inviting me to the show. So I won't be able to speak on HDFC Bank since we are the subsidiary and we are not allowed from the compliance to speak on HDFC Bank. But other than that, we have seen a markets rallying post the new year, and we have been a little cautious on the market. The valuations has reached a upper band around 22,000. We are almost at, if you look at the FY24 earnings, expected earnings of Nifty aggregate, we are looking at around 1,000 rupees per share. So 22 times this March 24 earnings and about 17 to 18 times next year earnings. So it does suggest that we are at the higher end of the band. That means that you have to be selected in the sectors which you bet on. We have been favoring the public sector banks compared to the private sector bank, and selective pharmaceuticals and capital goods players. So that's where we are asking investors to switch their portfolios and wait for a correction. We have seen first sign of that correction around at lower levels. Again, once prices become a little more attractive, we'll ask investors to deploy the cash which we have asked them to generate.
Yeah, absolutely. Devarsh, thank you for joining us, Tamanna here, and completely appreciate that you cannot make any specific comment on HDFC, which is in that sense the story of the day. We understand that. But, the question is that was this one result or this one bout of selling in one counter but just an excuse for a market which has been looking for a reason to book profits? Do you see that in this context? Do you see some of the global cues also now turning negative?
So one of the reasons why market has corrected, apart from these banks' results, there were concerns expressed by the RBI on high credit to deposit ratios, and if you read between the lines, that means that which has gone to about 100% CD ratio, the RBI would like it to go back to 80%. So what this implies is that the credit growth going forward will moderate, and that is also being discounted in current market. If you see the fall in the stock prices, the majority of the fall in the index is because of the private sector banks, and that's where the concerns are coming in. If there is a clear instruction or a guidance from RBI to moderate the credit growth, then obviously the numbers are little stretched, and that's why many investors may choose to book a little bit of profits here and wait for a better levels to enter. So obviously it is HDFC Bank result is one of the reasons why the index is down so much, but there are other concerns also which are playing their part.
Absolutely. What we're also seeing, though, there was just quick follow-up from me, is that most of the pain seems to be coming on your Nifty and Sensex. In fact, your Nifty IT is ticking up fairly smartly at this point. Your broader markets, yes, are feeling the pain, but not to that extent. Would that also explain that inherently you could be seeing this as an opportunity once the dust settles to add some counters to your portfolio?
No, so we would like to be more into the larger cap stocks. The mid and small cap stock, as you have mentioned, some of them have not corrected, but there are some specific pockets of strength. There are sectoral rotation that is at play. We do continue to like stocks in pharmaceutical and media side, and that's where they are seeing some positives there. We are seeing some flows there, but overall, I think if some of the mid cap and small cap or the broader market have not seen the kind of selling right now, I think it is an opportunity to lighten up. About 10% of the portfolio should be there in the cash, and overall we should favor more larger, more established players where the valuation comfort and the margin of safety is higher compared to many mid cap and small caps which are have run up a lot, and there is a opportunity to book profit and bring the overall beta of the portfolio down.
Right, Devarsh, we're at the low point of the day. To try and break this down a little bit more, you've spoken about pharma as well as media. Any specific names that you can talk to us about with regard to either pharma, domestic facing, more global facing? What within pharma do you like? And media has been a bit of an eccentric sector of sorts, if I can term it that way. It's been volatile. Any specific counters within media that you seem to like?
Right, so I won't be able to speak to you regarding the individual stocks, but I'll give you the broad theme. See, there are in a year where there are elections are there, where there is going to be higher demand for media, and there is a mergers going on, there is a consolidation going on in the sector, and opportunity is there because of the underweight positioning up by the large institutional player, as well as the improvement in the fundamentals of the sector, the advertising rates and the inventory for the other advertisement has come down, the prices have gone up, so delta for the earnings is still there. So that's why we like it. The pharmaceutical side, we continue to like the domestic players, the one which is catering to our own country, because they have a clear higher ROEs and the growth is relatively much better there compared to the US or the export sides, because we continue to find challenges there. So domestic facing, local brands, I think that's where in pharmaceutical we will find opportunities.
Yeah, absolutely. So some opportunities there perhaps coming in, but in a market which is in one direction right now, would you wait till the dust settles is the question. Thank you so much, Devarsh Vakil, for joining us and putting into perspective that yes, there was one set of numbers which were disappointing to some extent, but it wasn't that bad. This is a market looking for opportunities to correct. Let's come to stock-specific action that we're seeing today. And Jay, most weakness, unsurprisingly, on your banking counters. Look at a City Union Bank, look at a central bank today, all of them doing very, very poorly. What would be your take on some of these counters, and how, would you respond over here? Any kind of stocks which would be on your buy list right now at lower levels?
No, Tamanna. I know if you recall, Samina asked me in my last interaction if I would buy any banking stocks on the dip. I'd said I'd completely avoid banking stocks, and that continues to be the case. In fact, I would start looking out for shorting opportunities in the banking sector. To me, this turn in the banking sector of the banking stocks moving below 46,880 and 47,200. It's a very significant turn for me. It's possibly a medium to long-term top. So the next pullback when the markets bounces, that will probably be a sell on rise, and I think the markets have rolled over to a sell on rise. And so I'll completely avoid and start looking for shorting opportunities. And on a tactical allocation basis, I'm looking to be on the side of raising cash to somewhere between 75% to 100%. That's the flexibility the individual investors have versus a retail investor versus an institutional investor who has a maximum capability of raising cash to only 10%. That's most of the institutions can't even do that. So we are in such a situation. This is probably a big turn for the medium term. Wait for SBI to drop below 620. That will be additional pressure on the sector.
Right. Thanks so much for that, Jay. Let me quickly also invite Avinash Gorakshekar, who's the Director Research at Profit Mart Securities, to talk to us more about how he's viewing markets right now. Avinash, 8% now almost on HDFC Bank. Warranted?
I think it is slightly more of pessimism which is seen in the counter. I think clearly markets were looking at some sort of stability on the growth numbers, especially on the deposit side. I think my sense is you may have to wait for a couple of quarters before the consolidation impact gets fully reflected. But I think investors who want to take a 18-month call, I think definitely at these levels there's very little to lose in HDFC Bank. And I think as a portfolio strategy, we've been advising our clients that such kind of weaknesses should be used as an opportunity to accumulate stocks like HDFC Bank. We still believe that the banking sector will definitely show a strong growth trajectory in the coming year. I think it's a matter of time when market realizes it. But I think the deposit growth rates of most of the banks has been quite discouraging, and that is something which the markets have not liked. So I think it's going to be a deposit war, at least for the near term. And to that extent, I think the markets have obviously seen this correction. But fundamentally, I don't think it warrants such a heavy fall. So I think it's only a matter of time before the stock bounces back again. But yes, definitely, I think short-term traders obviously would have obviously made huge losses here. But from an investor standpoint of view, I think we are not worried. We would prefer to even buy at these levels, considering the longer-term kind of trajectory remains quite solid.
Right, stay with us, Avinash. Asian Paint numbers just come out, and at first glance, they're looking good. Consolidated revenue up about 5% year on year. Net profits, that figure is looking robust at about 34-35%. Remember, this is expected to be a good quarter because there was a deferment of your festive season, etc., which would have clocked in quarter three. So we'll take a look at what those numbers are looking at. Definitely on the net profit end, you are seeing double-digit growth. Volumes as well are expected to have improved. There are huge factors which will be baked into Asian Paints, and we'll wait for more details on those numbers and the fine print as well as we go through it. But think of it this way, that you've seen an improvement and uptick on the rural side and rural demand coming in. You have an increase in government expenditure and infra spends overall. That bodes well, for example, for an Asian Paints and the entire real estate housing boom you've seen. So for a company like Asian Paints, that would bode well as well. We'll get in more details on the Asian Paint numbers as we go forward and look at what really has worked for the largest player in this space right now.
There you go. You have the margin number coming in as well. It looks like a bit of a beat coming through, at least on first glance. At Tamanna, you've seen profit after tax come in almost 10% higher than what was estimated. But with that, let me go across to Mahima. She's standing by for a quick take with regard to what the numbers of Asian Paints really looks like. The fine print, Mahima, take it away.
Right, Hersh. So as you rightly mentioned, the results are not as per the expected estimates that we had in the preview. If we see the consolidated net sales have grown only by 5%, and if we see the EBIT margins has increased only by 400 BPS. And if we talk about the consolidation PAT, the number has been good. It has been up 34.5%. Volume growths have shown a double-digit growth, which is 12%, which is good for Asian Paints as compared to the last quarter. If we see the industrial business has shown a double-digit revenue growth, and overall we're seeing a 6.1% revenue growth in the coating business. Also, if we see soft raw material has seen an increase because of raw material prices down. The margins have increased by 400 BPS to 22.7%, and overall, if you see, the international business has also registered increased profitability with growth in Middle East and African markets. So overall, if you see, the profit margins have improved. However, the revenue growth has just seen a 5% growth.
Yeah. Mahima, any details coming in on market share? Because that was a big question for this category. You've had new players. Of course, Asian Paints is the leader. And more details on margins. The margins look like they have ticked up about 392 bips from what I can see. Was that better than expectations?
The margins have definitely performed better than the expectations. However, the revenue growth, as I mentioned, has not seen the high single-digit growth that we were expecting. It was around 9%. However, we've seen only 5.4% in the revenue growth.
Sure, absolutely point taken. So margins really aiding profitability is what it seems like on the Asian Paints numbers. But let's try and go to Avinash, should we? Try and understand what he views the numbers as. Avinash, it seems like 6%, 5% growth on the top line, but 34% growth on the bottom line, 12% on volumes. Your quick sense of the numbers just off the bat?
No, I think this was expected because, see, 12% volume growth is not bad, but the real trigger for the earnings has come because of the savings in raw material cost, especially crude oil prices. I think that has been a major reason the profitability has jumped significantly. I think with the kind of crude prices currently moving in a softer range, one could expect, that these margins could be sustained. I think we'll get some more inputs, once we have the management commentary and the outlook on the margin trajectory going forward. But I think this entire performance has been driven by better, raw material cost management, which has come down quite significantly. And I think this has been the main reason the profitability margins have jumped significantly. A 6% growth in top line has resulted in a 34% jump in the profit. So I think that is really the key, that how long these raw material prices, especially crude prices, remain low. At least in the near term, we believe at least till the next 3 to 4 months, crude prices, if they remain low, you could expect a stronger fourth quarter also, because clearly a festive season, one could have expected volume growth to be much higher. But 12% is not bad. But definitely, I think raw material crude prices would now be the key trigger as far as profitability is concerned going ahead.
Yeah, that's a very good point. Crude prices have been benign this quarter. But let's shift focus back to the markets, and the Nifty near its day's lows of 21,559. Right now seems to have slipped below the 21,600 mark as well. Nishal Maheshwari, CEO of Institutional Equities at Centrum, is joining us now on the phone line. Nishal, a very good afternoon to you. Not a very good afternoon for the markets, though. Where do you think that the panic is setting in? Would you set this as a bit of an overreaction to the HDFC Bank numbers? Was that just an excuse that the market was looking for?
Yeah, afternoon to all you guys. Yes, I think market was waiting for an excuse to correct, and I think HDFC has given. So what you have to look at it in this text basically that the market is in totally at a stage and valuation where any disappointment will get a very severe answer. Seen it in Polycap, there was some bad news and immediately the stock reacted 20%, 25% down. We've seen in a large cap stock like HDFC, one bad quarter and basically the stock is being pummeled basically to almost 6-7% down. So I'm saying when you are priced to perfection, I think this kind of wild moves will be there, and this is what we're witnessing.
In fact, HDFC down over 8% when we saw it last. So definitely a big hit, nearly 8.5% down now at 1539 levels. Do you see that drag extending to the entire space? Of course, the Bank Nifty is down now, but if investors are worried about what they saw in HDFC numbers, a lot of those issues would be sector specific or would impact other large institutions and other banks as well, isn't it, Nishal?
Yes, I think you see all the large cap banks have been down to 2 or 3%. And I think the major issue remains to be basically that we are seeing NIMs compressing. I think the peak of margins is already behind us, maybe a couple of quarters back, and now we are seeing NIMs getting compressed. So profitability and margin expansion, I think that theme is over. Now people are saying basically if the margins are going to go down and if the growth is not going to be the same, then obviously we are going to see lower profits. So I think some tweaking in numbers is going to definitely happen in the current quarter on the bank side. And that's what I think the market is start factoring now.
Right, Nischal. Hersh also joining in. Now, when I'm looking at the larger market, of course, there's been, as you correctly mentioned, a stellar run-up. But, when I'm looking at some of the private banking sector names, they're trading at largely in around their 5-year average valuations or below it. So how do you view this sector as a whole? Because we are seeing a cascading effect of HDFC on the larger private banks as well as on the public sector banks, but more on the private banks. Do you see this as a possible buying opportunity, especially in this basket?
I think today is too early for us to actually go out trying to bottom fishing at the moment. I think let's settle down. Let us see basically this is just the correction has started. Let us see basically where it is headed, maybe 1500, maybe 450 basically in HDFC from where it started. So let's see basically, so it's too early to start doing bottom fishing. There has been an issue and we have to wait and see if the other banks are following up or not. If they also show similar kind of tendency, I think you will see lower levels then. If not, then it is only an HDFC bank issue. Then I think market will start buying up the other banks. So I think it's wait and watch. I think it's too early for us to get into the rush into the market at the moment.
Nischal, just one quick question about whether this is an Indian market poised or ripe for correction sort of a picture that we're seeing, or there's a larger global picture here. I mean, Europe is down fairly sharply, between 1–1.5%. Even right now, you had weak global cues coming overnight. The Fed rate cut bubble is beginning to lose some fizz. Do you see all of those factors also playing in?
Yeah, I think so. Basically, we really look at it on globally. I think that's a major reason because I think HDFC is only to do with the Indian market. So all other places, basically, I think Fed, one of the Fed members, basically at Davos, has said that the market is factoring too many rate hikes. Fed is anyway indicating only 3 rate cuts, whereas the market was factoring in 6. And I think as of yesterday, after all these talking, I think the expectation of a March cut of 25 basis points has already been trimmed to 15 basis points. So I think world over the market is reacting to that. And I think we are seeing similar kind of situation in India also. Anyway, India had overdone it basically on the upside also. So I think you have seen more severe reaction in India.
That's an important point, Nischal Maheshwari. They're saying India had overdone it on the upside also. Now, the question is this, one sharp sort of pinch of profit booking that we're seeing, or do you expect this to continue for a bit? Are we done with the cut that was anticipated, or is there more to come in your view?
No, I think so. Basically, the pain has just started, actually. I think there would be, say, more cuts. I'm very sure because I think now the market has moved away from buy on dips to sell on rises. This kind of a correction actually has put it into that frame of mind. So I definitely believe there is some more time the market is going to spend at the lower end of the market and possibly maybe another 400–500 point cut before we maybe restart a journey up.
But what's your larger outlook when it comes to 2024? Because we're expecting rate cuts also to come through latter part of the year. How do you see the market move maybe over the next 12 months or so?
So I continue to believe basically that we are in a good situation both internationally as well as domestically because I think rate cuts are going to actually has always been positive for equities and it will be so. So I do not see a very severe corrections. Maybe 4–5% is the max I believe basically is going to happen. But on a longer term basis, basically, I continue to believe that equities will do well in 2024, and particularly for India, because I think the scenario in India is really a Goldilocks scenario.
All right. Nishal, thank you for that. Very clear thought coming there from Nishal Maheshwari, who says that there is more pain in this market. He sees another 400, 500 point cut coming in, saying we've moved from a buy on dips market to a sell on rise kind of a situation. The Nifty right now, well below the 21,600 mark, actually 2% down. Very quick break. We're coming back with more details on what exactly in the HDFC Bank numbers has investors so peeved, what's happening on the F&O side, all of that and more on the other side. Stay tuned.
Welcome back. You're watching India Market Close here on NDTV Profit. Well, the gash, especially on the benchmark, continues to go higher. We're now 2+% in the red, and we continue to slip. We're probably at the lowest point of the day. But to try and break down levels as well as what cues we're getting from F&O, we have Agam standing by. Agam, talk to us about, what is happening with regard to futures and options. What's the data pointing at? It's a tough day of trade.
Yeah, it's a deep, deep wounds coming through for all those who were longs and all those who were, well, short put options, because it's turned out to be, a stormy day, a stormy session, certainly. When it comes to the Nifty, well, that's seen a decline of 2%. Sure, we've seen this in the recent past, and we see a massive amount of unwinding when it comes to longs, which were made earlier, and we've seen about a near 3% decline in open interest. But today's was the day where the Bank Nifty was in focus, and that's where we've seen a catastrophic 4.3% decline on the index, and literally no one was expecting the index to close anywhere below 47,000, but we are at 46,000 right now. It's not every day that we see a cut of 2,000 points and over that on the Bank Nifty, and it's not every day that we in fact see a 4.25% decline on just one index, but that is the consequence of HDFC Bank, which is itself declining by nearly 9%. That is there's the other very uncommon side, and because of that we're seeing more losses in ICICI Bank, Axis Bank, State Bank of India, Kotak Mahindra Bank, all of them looking at a very large amount of shorts building into the system at the moment. The question really is that as we move into trade tomorrow, can we expect short covering? That's a question that's going to be very, very hard to answer, because for now, there's been a little bit of an acceleration as far as, well, the shorting is concerned. Now, we were talking about 46,000 on the lower end. You can't even see those strikes here. And you can't even see the 47,000 strikes. So this particular page is absolutely irrelevant, has been rendered irrelevant. Let's talk about the Nifty options space, and perhaps that's where we can see how things are panning out. So obviously we are going to see a lot more writing below the 22,000 mark. Want to very quickly address the open interest distribution as well, and here as well we're seeing the range once again shift lower. Just this morning we were talking about the range shifting higher, but once again the 22,000 mark, it becomes a little bit of a pivot at this point in time, so we'll be keeping an eye on that one as well. And to talk about stocks, that's where the banking for counters are in focus. So right at the top, we do have likes of HDFC Bank and Kotak Mahindra Bank will lead the losses coming through. Asian Paints, it's reacting to earnings, and that's where we are seeing some amount of shorts building in as well in City Union Bank along with that. To talk about a handful of other stocks, well, we are seeing longs and winding in Nalco and Aarti Industries, perhaps a bout of some relief in L&T Technologies, Nestle and Metropolis, which are seeing some amount of short covering. But it's going to be about short covering, and the question is when we see that short covering. For now, it does seem like it's going to be a challenging next couple of days, given the fact that we have seen an increase in the India Volatility Index as well.
Right. Thank you for that, Agam. For that quite a comprehensive kind of analysis. If we can quickly draw up HDFC Bank, that stock has slipped now nearly 9%. I have to go even before May of 2020 now, Tamanna, to try and figure out as to when was the last time we saw this. And the gash with regard to what HDFC is contributing, 250 negative
there you
points.
have it. It's falls most in a day since May 4th, 2020.
There you go.
Perhaps even further down. I mean, unheard of to see an HDFC Bank down 9%. If I just look at that fin service, the Nifty fin service, your IEX is down about 11%. Kotak Mahindra, Axis, all of them, ICICI Bank, all of them really getting badgered today.
Yeah, 1 lakh crore of market cap wiped off HDFC Bank alone in a single day. That's a statistic. And the other one is 250 points in terms of negative points contributed by HDFC Bank today alone in trade. Clearly, that's the stock in focus, and that's probably the one stock which is dragging the sentiment, at least, of the market.
But it's not just an HDFC Bank story. That might have been the the match that has lit the fuse. Sure. But definitely, this is an across the market sell-off, with this looking as the biggest pain point. I just want to get Jayabala in very quickly on how deep he sees this cut going, especially on the bank Nifty. Jay, any thoughts here? You're precariously, just above 46,000 right now. This entire index is down about 4.5%.
Yeah, Tamanna, spot on there, and insightful words there. It's the trigger, HDFC Bank, it's just a trigger, and it's just a match that lit it. And, as I said earlier in my opening statement, the fact that banking index went below 46,880 and 47,200, this opens up a medium-term correction. The levels I'm looking at, can be a bit shocking. And because, as I say, medium-term, I'm from the old school, medium to long-term, for me is anything beyond 9 to 12 months. So from a 9 to 12 months perspective, I'm looking at the banking index revisiting 32,000. So it's not a short-term call. But, it's something, this is a significant turn for me. And as you rightly put it, it's a trigger that started. HDFC Bank is a trigger that started it.
Sure, thanks for that, Jay. We'll continue to focus on HDFC Bank. We have with us, of course, our banking editor. Stock is slumped, disappointing third quarter earnings. Vishy, talk to us. What's really leading this large sell-off that we're seeing?
Right, Hersh. So as the numbers did point out, there's a worry around the deposit front. The bank's deposit accretion has slowed down significantly in the third quarter. The expectation that going ahead, the bank will start acquiring more deposits is looking a little iffy, because the entire market is, of course, after those limited deposits. So whether HDFC Bank will get a lion's share of that or not, that'll get clearer later. This also means that net interest margin is going to be a bit of a struggle going ahead. Over the last 2 quarters, NIM has been flat. If they go after deposits gung-ho and start offering higher rates, then that has a direct impact on the net interest margin. And at the end of it all, the question of advances growth. Now, HDFC Bank already sitting at 110% LDR, loan deposit ratio. If they have to bring that more into balance, then they will have to go down slower on the advances and push the deposits higher, which of course has implications on future business growth.
Just a quick follow-up, Vishy, to put it in the context of the reaction that we've seen and what the expectations were. We're still talking about one of India's most valued, best run and most prestigious private sector banks, HDFC Bank. Yes, they don't seem to have had a great quarter. A lot of the problems that you've described seem to be inherent to the sector right now. Yeah. So contextualize what we're seeing. It's not as if the results, should have evoked such panic. Is that fair to say?
Yeah, so Tamanna, to be fair, I'm not sure about the panic bit, but what I can definitely say is that this is not an HDFC Bank sole problem. The fact that deposit growth is slower is true for all private sector banks out in the system. The fact that you need to slow down on advances so that your loan deposit ratio comes in within a reasonable range, that is also true for all private banks in the system. So if that is the case, if you are going to slow down on lending and push up deposits, then the net interest margin problem similarly is not just an HDFC Bank problem, it's a problem for the entire sector. So this will play out as more banks come out with results. We have ICICI Bank coming out with its results on Saturday, and then Axis Bank the week after. So the three top private banks will be covered. Kotak Mahindra Bank, the fourth largest, would also come in by that time. So we will know what exactly the story is looking like for the rest of the private sector banking pack. But yes, the problem is not just an HDFC Bank problem, it's a sector-wide issue.
Like we said, it's the match that lit the fuse. Thank you so much for that, Vishy. We're taking a very quick break, but don't go away. Just a few minutes left for close. What would be your BTST idea? What should you do in a market like that in the last few minutes? All of that when we return.
Welcome back. You're watching India Market Close here on NDTV Profit. We're 2% lower on the Nifty, but I want to try and shift focus to some of the positives in the market. We have the IT index, which is doing or holding up fairly well today. It's been a good week, or rather last 5-6 odd sessions for the IT index. And, let me try and shift focus. Jay, your views with regard to IT, what pocket do you like, if at all, or are you just completely holding off at the moment?
If you recall from our previous interaction, Hersh, I had mentioned that, despite the negative news on Infosys when it was losing some order, I don't recall which one is exactly, I said it's due to cross the December highs, and it's done that. But that move has possibly completed the bounce from 2023 low, a corrective ascent. So so I will be quite neutral on the IT index. I won't have any positions. I will look for shorting opportunities. If the IT index were to drop below 34,200, and 3680 on TCS is very significant. So until that point, lock in the gains that you made over the last few weeks. So and watch for 34,200 as a critical support. If 34,200 gives in, it's a medium-term turn for the IT index.
Jay, what would be your top calls at this point?
Yeah, I'm bullish on Atul Auto. It's a positional call. I'm looking for a price objective somewhere close to 750. I think it will hold above 533, so that will be the stop. And I'm bearish on Bajaj Finserv. So it's a positional call once again. But if you want to play it for the short term, you can place like STBD, you can place a stop at 1611. But the positional price objective is somewhere close to 1100 and change. So it's a deep gash, if it were to come through. A stop loss at about 1750 for the positional call.
Sure. Avinash, if I can switch over, try and get your quick take with regard to Nifty IT. You've seen a good set overall. How do you view the IT sector as a whole? Good set, I'm not sure actually, so I'll probably retract that. But how do you view Nifty IT overall?
I think, in this kind of volatile markets, I think most of the investors are looking for some sort of protection. And I think in that terms, TCS numbers were slightly better than expectations. HCL Tech also reported a decent set of numbers. So I would believe that, investors who want to actually park their money in the near term should definitely look at one or two IT companies. In fact, the other interesting companies could be KPIT, Persistent. So, these are companies where I believe the visibility of earnings, the order book is pretty encouraging. Even companies like LTTS, reported a decent set of numbers. In fact, the management has very clearly indicated for a stronger margin outlook in the coming quarters. So I think clearly IT as a pack can definitely be looked upon. In fact, in our past interaction with our channel, I had actually told you that this is a good time to accumulate these companies because most of the negatives were into the prices. So I think this could be a good time to accumulate some good quality large cap IT names, some mid cap IT companies, and I think give some time because over the next say 2 to 3 quarters, once the recovery in the US market starts. You could see a decent amount of re-rating here because, most of the markets were negative on this sector and these stocks. So I think there's hardly any downside further left. So I would believe, yes, it's a good time to accumulate. But yes, the time frame should at least be 6 to 12 months. Only over that kind of period time frame, one could expect a decent risk reward.
Right. On the back of that, let me also try and pull out what L&T Tech had to say with regard to their numbers, as well as they've reiterated their revenue growth guidance. We've spoken with the company's managing director and CEO, Amit Chadha, to understand the rationale behind the same, or what's really giving them that kind of confidence and visibility. Listen to what he had to say.
We've been continuing to have deal wins over the last few quarters on a consistent basis. Last 2 quarters, all the segments have grown sequentially for us, and you can see it's a fairly secular growth. And therefore, we are fairly comfortable with that 17 to 18.5. There is a certain comfort in that 17.5 plus range, and we are working towards the rest of it. So we are, and that's why we are retaining our guidance, and we continue to work on it. The quarter is still in play.
Right. That was the management of L&T Tech. we've, or rather, we had Avinash speak about some of the higher growth IT companies is something that he prefers. But Avinash, we've still some way to go when it comes to the macros taking a turn, right? And we are seeing a bit of a correction in markets as well. How do you view valuations in this space? Because, something like a KPIT, some of these companies, they trade at a slightly elevated valuation as well. Should one be more cautious, especially when it comes to valuations in some of these names?
No, I think, as a strategy, investors should not, deploy 100% of their capital in one shot. Our sense is that, say, a 20% allocation at these levels and probably wait for a decent correction to enter, because ultimately, the return on capital or return on investment would definitely come in only when the entry price is ideal. I think the same applies for other sectors also. I would believe that the correction has started. If it continues for another, say, a week or two, I think this could be a good time to actually introspect and realign the portfolio and get into stronger companies, especially domestic sectors, where I think the growth is still there. I think in terms of earnings kind of growth, my sense is that this could be another good strong year, and hopefully my sense is that with commodity prices ruling low, crude prices down, there's going to be a lot of raw material kind of comfort to various sectors. So I think clearly the way the markets had gone up was very fast in a very short period of time. So I think investors will also have to fine tune their return expectations, their risk reward kind of multiples, and then obviously be invested in this market. So I think this should not be a panic kind of reaction by investors. But yes, I think at lower levels, we could find more value. So I would not deploy my entire capital. And I would reiterate that, there's a lot of value at lower levels. So we'll have to wait and watch for the next week or two. Possibly, the reaction in the markets would continue for a short period of time, and then we could see normalcy coming back again.
It's a risky time to perhaps go bottom fishing right now. But, let's talk about some counters which are not doing too badly. Aster DM Healthcare hit all-time highs yesterday, is still up in the green in a market like this, about 3% up. Odd. The news flow is that they're giving a hefty dividend to their shareholders after getting, rid of most of their GCC business. They've hived off that business completely and sold it. In fact, I spoke with Aster DM CEO today to understand what their strategy is going forward.
Our margin is around 16% at the consolidated level. At the hospital level, we are at 20% EBITDA. We are going to see expansion in that margin in terms of a CAGR of 25%. We are confident of at a consolidated level crossing that 20% EBITDA mark. At the hospital level, we should be crossing 25% EBITDA mark. So this is primarily got to do with the 2 or 3 main areas. See, if we are also ramping up, adding 1,500 beds, there's always a concern of dilution of the margins. But because we are focusing on the brownfield expansion, which is primarily leveraging on existing infrastructure and the clinical talent, most of the additional revenue which we are going to generate, majority of that will go to the bottom line. That is, having said that, apart from that, our ARPOB is right now at 40,000. We expect that to grow at 6 to 7% in the coming years, at a CAGR of 6 to 7%. We are hoping to reach by 55,000 by next 3 years. That is going to happen. They primarily got to do with the change in the case mix, because we are focusing heavily on moving all our hospital from the secondary and tertiary care to quaternary care. This case mix change will help him in driving the ARPOB.
Well, yes, that's what's keeping Aster DM not just afloat, but up 3%. Let me quickly move it to Jay. Jay, we're at the fag end now. What should investors do, and your BTST call, if you can give us that in maybe a minute?
Yeah, the BTST call is on Atul Auto, like I mentioned before, and the STBT call is on Bajaj Finserv. What investors should do, they should be looking to raise cash. This is not a time to buy the dip. And probably after several weeks, they're going to start realizing that this turn is not a blip in the short term. It's probably a change of trend in the medium term. We still have a little more work to do on the Nifty. Watch out for 21,448. If that were to go, I think the Nifty would also join the banking index that registered a medium-term turn today. So start looking to raise cash somewhere between at least 50% from here on. Probably, as the time progresses, we'll let you know that if you have to go to 100% cash.
Wow, that's quite a grim outlook right now. Thank you so much, Jay and Avinash, for staying with us through the afternoon as we wind down to close. And it's looking like quite a dismal close for the Indian markets today. Let's look at where we're ending. Near the day's lows is where you're seeing the Nifty. And let's pull up that full chart for the Nifty to give you a sense of the kind of rough markets that we have seen today. The Sensex down over 1,600 points towards the end of the day. It started with weakness in HDFC Bank, but it's clearly a bigger story. There you have it. The Nifty here close to its day's low and looking like it's going to clock nearly 450, 500 points down below the 21,600 level very comfortably, and in fact looking like it might reach 21,570 as well. Let's pull out that heat map to see what the big contributors have been and also see where most of the pain has come from. And of course, it is HDFC Bank. HDFC Bank down about 9% at one point, now a little over 8% down. Unseen levels. In fact, the last time you had this kind of a crack in HDFC Bank was in March of 2020. The steel stocks are also, metal stocks are also doing pretty badly. The fact is that the HDFC pain is overshadowing what is happening in the rest of the market as well. And it's not just the story of one bank, one counter, and one set of results. It's a broader story that we're seeing playing. Perhaps a bit of profit booking and a cool off in a market that by most accounts has seen a bit of, been in the overbought territory, a bit of frenzy perhaps. So Tata Steel down 4%, Kotak Mahindra, Axis Bank, ICICI Bank, all of them have had a pretty bad day. Your IT stocks have been, moving in the opposite direction. Maybe a defensive play there. Look at HCL Tech, Tech Mahindra, Infosys, LTIM, all of them up in the green. In fact, that's the only pop of green you'll probably see in the markets today. The biggest losers continuing to be on the bank of finance side of the story, sectorally as well. Post your Nifty Bank, Nifty Finance, look at the Nifty Bank levels, down about 4.5%. Important levels breached today on the bank Nifty. You have the metal stocks also getting hit pretty badly. Nothing has been spared, even Realty, Auto, all of them doing pretty badly. The Nifty IT, the only outlier there. So a couple of factors here. Yes, of course, it is about HDFC Bank. Yes, of course, it is about results. It is also a concern that this might spill into the broader space, and you might see this reflecting in other banks as well. But you have had weak global cues. So no real support coming in there, or no real balancing factor coming in there for a market like this. The Bank Nifty has just about managed to close above the 46,000 mark, but has shed over 2,000 points today. So it's been a rough day for the markets, no doubt. Have we seen the end of the pain, or is there more to go, is the big question. That's all the time we have on India Market Close from Hersh, me and the entire team that put the show together. Thank you for watching, but stay tuned. A lot more coming up, more analysis and more advice on what you should do next on the other side of this break.